All right, welcome to Coffee with Marcus and Mark, the number one stock market show on Spotify and one of the most popular market updates on YouTube. In this show, we talk about what's happening in the markets and how we're trading them. Today is Monday, April 14th, and here's a look at the markets. So, what comes next after one of the craziest weeks of trading ever? The bond market was a huge concern last night. We'll take a look at what was going on and why we might want to be concerned. Inflation looking better, but consumer sentiment is at or near historic lows. A surprise tariff exemption sets the week up for a nice gain or at least a nice start. We have more bank earnings, and we'll see what's in store for us this week. Plus, we'll take a look at our open positions. As you can see, there's a lot to talk about, so let's go ahead and get started. If this is your first time here, my name is Mark Hodge. I'm head coach at Rockwell Trading, and today I am going to be tackling the show by myself. Marcus is in Las Vegas for an event, and let's go ahead and see what's happening in the market. So let me jump on over to a chart here, and let's actually pop over and take a look at where we are with the S&P 500. The S&P 500 still below its 200-day moving average. This is that red line, and all of this volatility sparked by a global trade war and the concerns with tariffs. And last week, we had one of the craziest weeks I would say the markets have ever seen. Definitely in the last few years. Of course, there was COVID and the pandemic that started a big slide. We also experienced a bear market, but it was nothing quite like last week, where the S&P saw four consecutive losing days. Started the week off with losses. It looked like it was just going to get worse and ugly, and a lot of volatility going on. And then on Wednesday, President Trump announced a 90-day pause on tariffs. There was still that 10% increase, but not at the levels that investors were concerned about after Trump's press conference. And it looked like the focus had shifted towards China and tariffs on China. Now, there were retaliatory tariffs implemented by China that investors didn't quite like, but it appeared as though investors were much more comfortable with the bulk of the tariffs or the trade war being really directed towards China rather than the entire world, which kind of sparked this bigger concern and sell-off. With that volatility, you see it here in the VIX. The VIX, also known as the fear index. If you've never looked at the VIX or you're not familiar with it, the VIX tracks option premium in S&P 500 stocks. So when there's higher options premium, this is caused by investors or option buyers believing that there is a likelihood of greater swings in the market or greater volatility. And this is where, when we have downside and bigger drops to the downside, that's where volatility expands and increases. And we see that on Monday, we had a spike up to 60, which was just crazy. And then on Wednesday, after that pause in tariffs was announced by the White House, the VIX saw one of its biggest one-day drops. So we go from this huge volatility expansion to one of the biggest declines. If we look at a weekly chart here, we see that back in August of last year, we had a quick one-day spike, and then it came right back down. We have to go a little bit further out to see similar volatility. There was some of these spikes here in 2022 during the bear market. But the last time we had this type of volatility was during the pandemic in March and April. So with the pandemic and the uncertainty surrounding that, we had this prolonged period where the VIX was higher. But gosh, the spikes that we saw the last couple of weeks here, and right now still at elevated levels, even though the VIX has come down today with the markets higher. VIX has seen a pretty decent drop, but at 31, this is still elevated. Now, we have to take a look at yields. And with yields, we actually are experiencing, well, what happens is when bonds are coming down, yields are going up. And when yields are coming down, bonds are going up. So there's an inverse relationship between yields and bonds. And this can really, well, the reason why bonds go up or down is because of supply and demand, right? Essentially. Let's look at the 30-year bond market, which the symbol is ZB here. So US Treasury bonds. We see that last week we started to see bonds. So these are not yields, but bonds coming down significantly. So with the tariff talk and situation, bonds started to increase, and you had a 1, 2, 3, 4, 5 day rally in the bond market. So this means that people are buying bonds. Now, why would you buy bonds? Well, it's a bit of a flight to safety, right? If you believe that bonds are going to be more attractive than U.S. equities. But where are you going to put your money? If you have a lot of money, you can invest it in the stock market, and especially when there's lower volatility and you believe that the markets are just going to drift higher and continue to move higher, then having risk on in the market makes sense. Because if the S&P 500 is averaging 10 to 12% and bonds are paying 4%, you can basically triple those type of yields with a little more risk in the stock market. So it's normal for bonds to start to increase when the markets are seeing a little more volatility. You take a little risk off out of the equity market, put it into safer interest-bearing investments. This is what typically happens when there are chaotic periods in the market, like 9/11 or the financial crisis. However, we started to see a real sharp decline here in bonds. So this means that people were selling bonds, which isn't usually what you get in this type of situation. I remember back in the financial crisis, Marcus and I, we were at an event. We were talking with a broker based in Chicago, and there was someone big in the CME group at the time that had talked to that broker. And this is when Lehman Brothers was collapsing, and that person at the CME group, he said, "I don't know what anybody else is doing, but I am buying bonds, selling equities. This is going to get ugly," right? So that's the focus when you have this type of event where there's a worry or concern. That was not happening last week. So that got real chaotic. And this is because there's a lack in confidence in the financial markets altogether. That's not good, right? Now, it could be that this is some speculation because China and Japan in particular owns a lot of U.S. debt. Could it be that China was selling bonds? Possibly. But nonetheless, it created a lot, well, almost a bigger concern than what was going on in the stock market. Now, since then, things have stabilized a little bit. Equity markets have moved higher. And if we go back to the S&P 500, and we see now that after that announcement, there was a great, huge day. The S&P 500 jumped 9.5%, down on Thursday, but a rally on Friday put the S&P up on a weekly basis, up 5.7%. The Dow was up 5%, but it was the NASDAQ that actually saw the biggest swing, up 7.2%, 7.3%. And if we look at where we started the beginning of last week and where we ended up, that's an 11, 12% swing. And from top to bottom, it was about a 16% swing last week. So it was just nuts. It was a week like we haven't seen in a long time. And I mean, this gets right up there with the pandemic move and going back to 2008 and the housing crisis. You don't see these types of swings every day. Now, heading into this week, the S&P 500, pardon me, is up 1.3%. The Dow is up 1%. And the NASDAQ slightly higher, leading the way earlier, but pulled back a little bit with a 1.4% gain. This comes after a surprise move by the White House where there was an announcement that we would see some tariff exemptions, and this definitely helping the markets as we went into trading this week. The exemptions are or this would be tariff exemptions for PCs, memory chips, smartphones, and some other electronics. So that definitely helping tech. Apple in particular, if we look at Apple, really suffering from last week's moves. On a weekly chart, we can see we were able to bounce back 5.2% last week, but the week prior down 13.5%. So some big swings there. Today, Apple opened up at 211.44. Right now, still 3.2% higher, but Apple definitely benefiting from those exemptions. Apple having a lot of exposure to China, with Apple building its whole product line with relationships in China with more than 1,000 suppliers and over 1 million workers. They have tried to switch some production to India and Vietnam, so there isn't all of that exposure to China. But Apple definitely benefiting from that exemption. Now, the White House has confirmed that it's a temporary exemption, but we'll see exactly how that plays out. So, what a week! What a week! Now, let's look at the economic calendar here, and I actually want to go back to last week. This was kind of overshadowed by everything going on with tariffs, and I think this will continue to be the case. But CPI data actually coming in better than expected, coming in with a 0.1% increase. That's core CPI. CPI itself, a drop of minus 0.1%. So if it wasn't for tariffs, this actually would have been really highlighted in a spotlight here. It was the first CPI decline in almost 5 years, helped out by the drop in gas prices year over year. We're at 2.4%, and core was at a 2.8% increase year over year, which was the smallest gain since March of 2021. So this would have been huge news if it wasn't for the tariff situation. Now, in spite of these nice CPI or inflation numbers, because PPI showed a similar drop, this does not factor in the price increase that we're going to see from the tariffs being added. So next month's could be more significant, but definitely something to note. Also, something to note, preliminary University of Michigan consumer sentiment, a reading of 50.8. It's my understanding that this is the second lowest reading on record. So consumers a little bit concerned about the economic landscape and what's to come. Now, let's take a peek at a few names here, and let's go back here. Let's first take a look at JP Morgan. So big banks kicking off earnings season. Last week, JP Morgan on Friday reporting earnings. Nice earnings surprise on revenue. Also a nice earnings beat with strong consumer spending. So banks look really good. However, the concerns over tariffs definitely being part of guidance. Not quite sure what's to come. But JP Morgan up on Friday, 4%, pulling back a little bit, down just shy of 1% today. We had Wells Fargo reporting earnings, finishing lower for the day, but also an earnings beat, a huge earnings beat, although Wells Fargo missed on revenue. Morgan Stanley also reporting on Friday, opening lower and then rallying, finishing higher by 1.8%. Today, Morgan Stanley adding 1.8%. Morgan Stanley earnings beat, revenue beat, just like JP Morgan. Now, this morning, Goldman Sachs reported earnings. Goldman Sachs, a nice start to the day, up a little bit less than 2% right now, but similar to what we've seen so far from the other finance companies, banks reporting earnings. A big jump on the earnings per share versus what was estimated, and then also a nice move with revenue. So let's move on to some open positions, and let me go back to PowerX Optimizer. Let's look at the WTF scanner here. No new signals, no exits today, but there are two open positions. We have, let's start with BMY. So BMY is a trade that I took. There was an entry here on April 7th, and I did add to this position with a 5% add, so I got in at a lower price. And right now, making a move higher, but still open, down from the original entry signal. But I have added to this position to bring down my cost basis. Now, GILD is looking pretty good here. We had an entry signal on April 9th, right at the open, and we see it's been up from there. Today, GILD up 2.6%. My guess is we'll get an exit signal at the end of the day for tomorrow's open. We'll have to see. But GILD looking real good right now. These are the two WTF trades that I am currently in. If we move on to the wheel and we take a look at things, CSIQ, as would be expected with a tariff situation like we had last week, having a bit of a drop, but looking at some nice support around 7 up today with the overall market. Halliburton pulling back last week with the tariff situation. Also that unprecedented, well, I wouldn't necessarily say unprecedented, but unexpected OPEC output increase that was announced, and Halliburton getting hit a little bit. Today, giving back some of the early gains, but it does look like we have some nice support around $20. Nothing for me to do right now with Halliburton based on a position that I have established here. My cost basis is $30.80 and my break even is $29.70. Now, IWM is a position both Marcus and I are in, and we actually have my cost basis is $199.75. My break even is $196.25. And right now, looking to see a little more of a follow through to the upside here, where I could sell calls at 200. Can't do that right now. Coles is not a position I am in. Marcus is in this one and getting hit with the tariff situation. But just like we saw with some of those other positions, it does look like we have some support based on the moves and ranges that we had last week, and we'll just have to see if that support holds. Merck is another trade that Marcus is in. I am not right now. Marcus waiting to see if he wants to fly a rescue, but there is some uncertainty with Merck and potential tariffs here, so he's waiting to hear if there's any news there and a little more information before continuing with the rescue mission on this one. Micron is a trade that I took over the last couple of weeks, and because of the positions I have established, my cost basis is $73.75 on this one. Break even right now. So what I did is I was selling calls basically at my cost basis at the 74 strike. But I was also trying to sell calls at a higher strike to capitalize on a move higher should one come. And last week I sold the 81 calls on half of the position. I sold the 74 calls on half of the position. Now those 81 calls on that quick pullback, I was able to buy those back at 80% max profit. And the 74 calls that I sold, I actually rolled out to this week. So I was able to get, I think, $1.10 or $1.15 on that roll. At the time, it was more than 60% annualized based on the premium collected. And so I rolled half of my position to this Friday with a 74 strike. And then this morning with this gap higher on the exemptions there benefiting MU, I was able to sell the 77 call for the other half of my position. And I want to say I got $1.05 on that, which I think was like 128% annualized. So I have the 74 expiring Friday, the 78 or 77, expiring Friday, and some nice premium here. My goal right now is to continue to do this, where I would like to get as much premium near my cost basis as I can, but on the other half of the position, try to sell calls at a higher price in case we could rally back up to this support level around 84, 86, somewhere in this range, which I do believe that is possible. But we're not out of the woods yet with the tariff situation. I think that this week could be key. Now, UPS is another one that dipped on the tariff situation. Right now, looks like we might be seeing some resistance around 100. And of course, I would like to see this move higher. My effective break even after a position that I established is essentially 132.87. So I have a ways to go, but at the same time, nice to see that we rebounded off of these lows and looking for this to continue to move higher in an environment that has less uncertainty. Markets don't like uncertainty, and that's exactly what we had last week. So let's see if with this 90-day pause, if there is some more information there, some more negotiations, some more positive news, and hopefully the US and China could come up with a win-win situation to drop those tariffs, come up with some arrangement and agreement. I think that the markets would love that, and we could get a huge rally based on that news. But until we get some progress, there's going to be a lot of volatility, and I think that this week can be crucial. Now, let's look at the economic calendar here, and we see that for this week, Fed member day to day, just Fed speak all over. But this week's all about tariffs and earnings. If we look at the economic calendar, a few minor items on the economic calendar, we have core retail sales on Wednesday, an hour before U.S. markets open. We do have Fed Chair Powell speaking in the afternoon, but as far as the economic calendar, not a whole lot going on. If we look at the earnings calendar, we continue to see some bigger names reporting. J&J before the bell tomorrow, Bank of America, Citigroup, PNC Financial, all before the bell. United Airlines after the bell. Looking ahead, Abbott Laboratory, Progressive, U.S. Bank. We have United Healthcare, Netflix, American Express, Blackstone, Charles Schwab, and Blackstone, the financial institution, not the griddle, although I'm a fan of the griddle. But yeah, I mean, there's a lot looking at the earnings calendar. Now we get a little bit more into earnings next week and the following week. But I think that right now, investors want to know what's going on with the tariff situation. Is it just going to get worse, or is there going to be a huge development that paints a better picture that's more positive with some certainty, clarifying some of this uncertainty? Because we have this pause, but just how long is up in the air, and also what could come out of the White House, positive or negative, that's unknown. So the tariff situation is huge, but I also think that investors, even though this is just the start of earnings season and we really get into the thick of it next week and the following week, guidance, if there's any guidance that is really starting to share the impact of tariffs and costs and what is expected. I mean, I know that Delta reported earnings and they pulled their guidance for the year. Basically, I think that in the third and fourth quarter, they're hoping to be profitable rather than increasing their guidance for the year. Don't quote me on that, but I know that they did pull their original numbers because of the uncertainty that we're seeing. But nonetheless, earnings and tariffs this week going to be the focus, and we'll have to see what comes. So I know that some of you come for the market commentary and analysis that we share. Some of you stay for the dad joke, and I apologize for those of you who stay for the dad joke, because most of the time they're really bad. Not to say that we're going to break from the norm today, but with that said, you know why you never want to iron 4-leaf clovers? You don't want to press your luck. I'll leave it at that. So I hope you enjoyed this video. If you did, please give it a thumbs up. If you have some comments on what's going on in these markets, what you think, what you expect, feel free to share. If you just like this video, please comment on it. We appreciate the comments that everybody shares. And of course, if you're new to the channel, please subscribe. We will be back here on Monday. Marcus will be joining me. One thing to point out, Friday, U.S. markets are closed for Good Friday. So it is a short week, and then a full week on, well, next week. So we'll see you back here then. Until then, happy trading, everybody.